Thank you.
Thank you. Mr. Schock is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses. A couple quick follow-up questions. One on cash accounting. I'm pleased that the chairman included the framework of Mr. Thompson in my bill that increased the threshold from $5 million to $10 million permanently. However, I'm aware of specific groups in my district who were exempted from current law that allow for unlimited amounts to be used on cash accounting, particularly in the ag industry. I've got some large pork producers that currently are allowed to use cash accounting. So I'm wondering, from your perspectives, if you're aware of other folks who may be exempted currently that will not be exempted under the chairman's proposal, and if you could talk a little bit about what effect this will have on perhaps accountants or others in the service sector, or a large pork producer like the ones in my district that have to go from an accrual basis to a cash basis if, in fact, there are no exemptions for folks over $10 million. Mr. Nichols?
I mean, so people being forced to essentially go from a cash basis to an accrual basis.
Correct. I'm sorry, yes.
Well, one of the big exemptions that currently exists in that is closely held S corporations are exempt currently, and this essentially would eliminate that exemption for all S corporations below the $10 million level. And so as a and that, I think any time you vary from the cash being in the door to pay the tax and you're requiring tax to be paid, perhaps before it, in this case, before it's collected, you should take into account that you are creating a cash flow situation that is potentially problematic. Under the current rules, there are a number of corporations, S corporations and partnerships that don't have C corporations as partners, that are eligible for the cash basis method of accounting. This would eliminate that. It would essentially create another one of these demarcation lines that is somewhat arbitrary, unavoidably. If it's 10 million, if they move $1 million above 10 million for 3 years in a row, then suddenly they're on a completely different system. And there I would focus on, is there a policy reason that's important enough to require enterprises that haven't collected the cash right away, they haven't collected the cash already, is there a policy reason important enough to require them to pay the tax on that income that they haven't received yet? And that's, if it's not broken, don't fix it. Be careful if you change things so as not to disrupt the business.
Mr. Harris?
Just to add to that, I think we have to understand that the only real difference between cash and accounting is when the income shows up, not if it shows up. So to his point, what is the incentive to require the perhaps accelerated reporting of the income? What is the benefit of doing that as opposed to waiting until it actually shows up? Because it will eventually show up and be income when the money is paid. So unless there is a real policy reason, as he said, to force that acceleration into income, I don't know why we don't just wait until they actually have it.
Okay. Well, might have something to do with the CBO score. Second question really is just genuinely interested in your view on this effect on small businesses. A lot of times we focus on the big C Corp guys. Got a few of those important ones in my district, but we also recognize that the majority of Americans work for small companies, and it's the startups really who are the engine of our economy. And some of the things we do, like 179, raising that threshold to 250, making that permanent. Is there anything else you guys are aware of that maybe we aren't doing that we should be doing, or perhaps we should look at, particularly for small startup companies? You think about the Apples, the Microsofts. They started in garages. They didn't have your traditional framework. You're not going to use R&D incentives for a small startup like that. Are there other things that we could be looking at for some of those organic startups?
I think we've discussed a lot of the things that we should do. Again, when you're starting up at the smallest of small businesses, cash flow is just of critical importance. They don't have access to capital. They're probably doing it from maybe even credit cards or living on a spouse's salary. So we should do everything we can to allow them to keep as much of their cash as they can and not get into complicated broadening base exercises, if you will, which is basically saying something you've spent can't be reported yet, can't be deducted yet, is to allow them to keep the money in their startup years when it's the most critical, because if they can get through those 1 or 2 startup years, they tend to have a chance to survive. So we should be very careful to do everything we can in a startup mode to allow their tax return to mirror their cash flow as closely as possible, because cash is at a premium at that point.
Anyone else? Mr. Nichols?
Well, I'm finding myself agreeing with Mr. Harris more and more. But essentially, and to a great extent, what I'm going to do is repeat what he just said, but essentially, there are 2 ways. One is by recognizing income only when it's collected, and the other one is by giving the benefit of deductions to startup businesses when they actually pay it, as opposed to over time. And both of those, frankly, help small business, especially startups who are cash starved.
And what's proposed in the rough draft you feel is sufficient?
It's an improvement. I don't disagree with Mr. Harris that the idea of allowing startups to actually expense, at least maybe up to a cap, actually expense immediately startup expenses. I'm not sure that's bad policy. I understand it costs revenue, but it's putting the incentives towards starting up businesses right where they should be. At least, you know, I'm going to get my deduction when I'm paying the cash out.
Yeah. Okay. Thank you, guys.
Thank you, Mr. Schock. Mr. Marchant, recognized for 5 minutes.